Good afternoon, everyone. Thank you for joining CFA Society San Francisco Wealth Management Series. I'm Steve Biggs, co-chair of the Member Programming and Content Committee. Today we're joined by Kelsi Rahm of Morgan Stanley, John Quigely of Great Lake Advisors, April Cody from MSCI. So to start, I'm just going to go around and have everyone tell us a little bit about yourself and your firm, what kind of clients you work with, and how you help them. And also, if you could please share some viewpoints. Start with Kelsi. You're on my, on my right.
Hi, everyone. I'm Kelsi Rahm, a financial advisor at Morgan Stanley in Minnesota. I work with individuals, families, and some nonprofit organizations. And I primarily do comprehensive wealth management and incorporate investment, obviously do the investment management piece of it and incorporate investment sustainability solutions into portfolios where it makes sense.
Thanks, Kelsi. April?
Hi, everyone. April Cody. Thank you for the invitation to participate in today's session. I lead MSCI's ESG and climate product strategy and strategic partnerships for the wealth segment based in San Francisco. And for those not familiar with MSCI, MSCI is a leader in both climate and ESG research. And we have a dedicated climate research team and a climate risk center, actually, based in Geneva, with over 500 research members globally. And they produce ESG and climate research on our universe of over 17,000 unique issuers and over 750,000 securities globally. And then that climate and ESG data is incorporated into about 1,500 equity and fixed income climate indexes that are calculated daily. In regards to climate, or pardon me, client segments, so we work with global pension funds, endowments, foundations, wealth managers, banks, insurance companies, hedge funds. And as I mentioned earlier, I'm focused on the wealth and the direct channels.
Thanks, April. Go to John.
Hey, good afternoon, everybody. I'm John Quigely. I'm the Chief Investment Officer with a disciplined equity team at Great Lakes Advisors. Great Lakes Advisors is a $17 billion registered investment advisor. My team down in Tampa runs a suite of quantitative strategies. We're actually the first quantitative investment firm to sign on with the UNPRI way back in 2008. We run a host of ESG strategies, including climate-focused, faith-based, and gender equality type strategies. The firm overall, it really has 40 years of what we call serving those who serve others. And that includes financial advisors with high net worth clients, consultants and institutions. And what we really do in the strategies that I mentioned is we strive to build core investment portfolios that can take a place as an anchor tenant in a client's overall investment allocation strategy.
Thanks, John. And I should mention to the audience, if you have any questions, please just type them in the Q&A box and we will get to those towards the end of the event. So kind of going around again, if you could just give us a little bit of an idea of how your firms are embracing climate and responsible investing. And we can go to Kelsi first if you have anything to add there.
First. Well, at Morgan Stanley, the firm has incorporated a lot of different resources around sustainable investment solutions around impact investing and ESG. And they've done a lot of work on a corporate level and as well as due diligence on the different managers that the advisors can choose for portfolios. When I got started as an advisor, I became more aware of the ESG space a long time ago when family foundations were looking for a way to add investments into their portfolios to align with the mission of their organization. And at that point, it was really limited to the amount of resources that were available to really incorporate a full-blown asset allocation model in a portfolio. We are really limited to a couple different managers. What I like about Morgan Stanley is that the tools and the access that we have to different advisors out there are very broad and quite a great selection of different managers. So for me, when I start this conversation with a client, it's usually people know that I'm in this space, that I think that we can align portfolios to their values. And I start with obviously their investment objectives and their goals. And we usually learn right on as far as what areas that they care about. And then I look at, obviously on an asset allocation level, how I can incorporate managers into the different asset classes. And I use Morgan Stanley's tools to kind of help plug in the managers where it makes the most sense. For me, the best way and the way that this has worked for my clients is I really focus on financial return and where we can align to their values. And if I have a client that's very wants to focus on one specific area and one thematic area for the entire portfolio, then we'll carve out part of the assets to go in that space. So I just have a lot of tools and resources that include what John and what April are going to be talking about. So it's quite an honor to kind of hear them speak, because what I feel like my job is really the connector to put the portfolios together, but bring in April, bring in John to talk about really all the work that they're doing, because that's what my clients really want to hear about. So I'll leave it there, I guess.
Okay, let's go moving to April.
Okay, great. Well, I'll talk about the actual, tools and solutions that we have for clients a little later, but I would highlight that ESG and climate are really core to MSCI's business. And in the last, I'd say, 2-3 years plus, climate has emerged as a priority. And we've actually pulled climate out of the environmental pillar of ESG. Historically or traditionally, climate was integrated within that, environmental pillar. And so we've really pulled it out so we can focus specifically on solutions, climate risk and impact solutions for our end clients. So, as we see more regulations emerging and our clients are being held to higher standards in terms of, both reporting and climate risk integration, we need to be able to help answer those questions and provide solutions. And, those solutions could be analytics, it could be reporting solutions, it could be data sets, metrics, it could be models, analytics. So really helping, provide solutions to the markets that are going to help our end clients. So climate really is a strategic focus of MSCI, which I think is, represented by us pulling climate out of the E pillar of ESG.
Thanks, April. And John.
Yeah, I think I agree with Kelsi that, in terms of viewing the role as a connector, I guess we're a little bit different connector in that my firm would kind of sit in between what April's group is doing at MSCI and what Kelsi is providing for our clients with Morgan Stanley. So our job is really to understand what the client needs are via the advisor and understand what we can bring to bear, what information we can bring to bear to help fulfill the client's goals. And so that's kind of working very closely with MSCI to understand what type of information is available and collect that information and integrate it into our investment process in a way that will produce market returns, but also better align with the investor's goals. So to that end, we've been fully integrating ESG ratings since 2008, so about 15 years now. And as a quantitative manager, again, being pretty early to the responsible investing space and really early in terms of taking ESG ratings and integrating it into our process, what we felt we could do to also help other advisors and clients is to begin to publish a lot of research related to ESG ratings. both the pros and the cons of integrating ESG, and ways that you could perhaps overcome any of the drawbacks related to the data. So what we saw was that companies that rated really well along ESG lines, the pro of that was they had much lower total volatility, and they also had less tail risk associated with them. And of course, there are anecdotal reasons that we can all think of as to why that might be the case. So that was a real benefit of integrating ESG is to get those type of volatility attributes into the portfolio. The drawback, however, was that the data, especially in the early going, was pretty unbalanced. So that what you'd see is certain sectors were very overrepresented in that in the group that were the highest ESG rated companies. In addition to that, we saw other risk factor attributes inside the ratings information, so that if we think again about highly rated companies and comparing them to the worst rated companies, you'd see a bias towards the very largest companies. Often the highest rated companies were value type plays, high dividend payers, low beta stocks. So if you really let ESG ratings drive the bus, if you will, you would wind up with these systematic risks in the portfolio that you don't expect to get paid for. So we also published quite a bit of information with respect to how we could correct for some of these issues with the data and still preserve those volatility attributes that we wanted to preserve. So, kind of getting that education out into the space we felt was really important. The other thing that I would mention in terms of embracing climate investing is that we launched a climate opportunities strategy actually 10 years ago on April 1st. So very early in terms of integrating climate concerns as well. And we're doing many things there, again, kind of connecting the information that April's team at MSCI provides, using that information to provide solutions for Kelsi's group at Morgan Stanley. And that will include things like reducing overall emissions in the portfolio. It will include investing more heavily in companies with very strong patent portfolios related to climate opportunities. It will involve doubling investment in those climate solutions. So things like renewable energy, energy efficiency products, green architecture, sustainable agriculture. Those are themes that we can invest in more heavily today, and there'll be more in the future. And do all of this in a way that doesn't get the portfolio to be such a niche portfolio that it no longer kind of holds that anchor tenant place in a client's overall asset allocation.
Thanks, John. Now, April, you had mentioned the tools or alluded to tools that you have to help advisors work with clients. And, I had always thought of MSCI as an index company up until, 5 or 6 years ago when I started hearing more on the ESG side. So maybe you could get into that a little bit. And John, you mentioned you use some of those tools. So if you have anything to add on how you use them, that would be great as well.
Yeah, absolutely. I think that's probably commonplace. Many people think of us as an index provider, but we have been providing ESG research for over 30 years. So we have been, and we're actually the first firm to do ESG ratings based on financial materiality. So just a side note on that. But yeah, so clearly, climate as a topic overall and ESG for that matter have really been picking up, in the media, and there's been, every day you see the headlines, there's something, coming up. And so obviously wealth managers and advisors need solutions and tools to answer those questions and help their clients. So I can highlight a few ways that MSCI supports those conversations and helps create client-centric solutions. So first, we would start with climate data. So there's no shortage of climate data. We have pardon me, I was going to say 100,000, but 1,000 climate data points that cover over 10,000 companies. And it's not a one-size-fits-all, though. So really the goal for a wealth manager or advisor is to narrow down that field of climate data points. You don't want to be presenting 1,000 climate data points to your end clients, but you want to pick a set based on their objectives and expectations. And then you can use different combinations of data to create, bespoke solutions for clients. And then when we move from climate data and that, universe of climate data and metrics, we move to integration. So the first step would be measuring a baseline, and that would be understanding the carbon emission footprint today, and then moving forward to a forward-looking assessment or projecting those emissions into the future to understand the impact of a portfolio on climate change or global warming, which brings in the metric, what we call the MSCI implied temperature rise, or ITR in our world. And so implied temperature rise really you can think of as an impact metric versus, some of those other data points that are measuring a footprint, the carbon emissions. And so it asks what a company's activities will mean for future climate change and takes a 2 degrees Celsius warming budget. And we assess over about 10,000 companies, looking at their current and future greenhouse gas emissions. And then additionally, we look at publicly stated carbon reduction targets. And then the output is how well those companies are aligned to the warming budget. So for example, Exxon, we could say if every company was Exxon, the world would warm by 3.2 degrees Celsius. I don't know if that's actually accurate right at this date, so please don't quote me, but that's just an example. And so we calculate implied temperature rise for over 10,000 companies. And then we also aggregate it at the fund level. So for 65,000 ETFs and mutual funds, we provide an aggregate implied temperature rise metric. And the use case for this could be, very widespread. We see clients reporting it, such as what was mentioned by John, on client statements and year-end reviews. It should be also used, obviously, in tandem with financial metrics. So, historically, advisors start with, what is your risk tolerance? But you can now also use implied temperature rise to ask, what is your climate alignment to investors? And so it helps tell that story of how a portfolio is impacting global warming or how climate aware it is, which we're seeing a demand for. And then if I have just a couple more minutes, I would highlight a couple other use cases, if that's okay.
Absolutely.
So great. So separate from implied temperature rise, we'd highlight that we're seeing climate data being used at the security level to build funds and to build portfolios or for manager due diligence. And so obviously fund managers are creating climate products now. And we've seen exponentially in the last few years the number of climate ETFs increase. And so wealth manager due diligence teams can use our MSCI data to supplement their traditional due diligence process and assess really if the fund manager is delivering the climate benefit that they are promising. So that's been definitely a growing use case. And then we're also seeing the emergence of climate model portfolios. And so as climate has emerged as a priority area for investors, more investors are asking for climate aware portfolios and looking to advisors to create more personalized portfolios that capture their climate values or preferences. And so we're seeing the use of climate portfolios that capture those preferences, but I also look to keep the financial objectives or risk appetite of the investor.
Okay, thanks.
If I could add on to some of those comments, we find a lot of value in the implied temperature rise data set. And the way that we think about this is, again, in talking with advisors like Kelsi that may have clients that, are employed in some of the industries that are being, quote unquote, targeted in this transition. A really, I think, traditional widespread response for those that are concerned with the environment has just been divestment. And we think that divestment has been a really good signaling mechanism for companies in the energy and utilities sectors that maybe business as usual can't continue forever. But the long-term goal of reaching net zero by 2050 is really going to require the skills of the laborers in the energy and utilities sectors. And if we combine that idea with what we've seen in the Inflation Reduction Act and how that should impact employment, we begin to see this idea that workers in these groups, not only should the number of jobs be maintained in those industries, but probably should grow. And a lot of the trade unions, in fact, should grow some of their employment as it relates to this energy transition. So if we think about the energy sector, for example, the engineering expertise that these companies have in their workforce, the distribution systems that these companies own, think about carbon capture and sequestration, geothermal. If we think about ways to store energy, something like pressurized underground storage, blue and green hydrogen, synthetic fuels, pipelines, these energy companies are really going to be critical in this transition. And then when we think about the utility sector, we think about how the price of solar has been brought down because of utility scale solar. That demand being so large, that's really helped bring down the cost of solar. And the same thing has happened, of course, with wind, both onshore and now developing in offshore. High voltage transmission, battery storage, load optimization. These are all skills that are residing in utility companies today. And so we think just kind of blanket divestment, maybe not the best answer, but being able to create a portfolio of companies that is still aligned with net zero by 2050. They may not be there today. April mentioned ExxonMobil, which, by the way, in their implied temperature rise data set, if they adhere to whatever commitments they have today, that would result in 6.7 degrees of global warming by 2050. But it's actually possible to build a portfolio of companies, including energy companies and utility companies, that still aligns with net zero by 2050 if you target the right companies. And that implied temperature rise data set really helps us do that.
Thanks. Yeah. Great. So April produces the data, John manages the portfolios with it, and Kelsi's kind of on the front lines talking to clients. So Kelsi, how do you, and I know sometimes with investments especially, it's going to be a lot of education around an investment style or theme, and particularly in the case of ESG investing, it may be connotated with lower returns. How do you go about educating and talking to clients on those subjects?
Yeah, I love this because I think for me, I've always looked at it as I'm out there competing. So if whatever portfolio manager, whatever investment I'm choosing for a portfolio, it has to compete with the traditional investments that might fit in that box, a large cap core, large cap, whatever value or growth, and same with small cap. And so I try to construct a portfolio that I can say financial return first, we're going to meet your investment objectives, but we're going to integrate solutions where it makes sense. And if it doesn't make sense, I won't use it because I want the financial return piece to keep up or outperform the basic benchmarks. And so I use regular broad-based indexes as a measure so that I can kind of follow along and make sure that I'm doing the best job that I can. And I look at stocks, bonds, and alternatives. And, I would say for liquid alternatives, we've had less options available. But as John was mentioning, as I look at asset classes within alternatives, now all of a sudden we have a new opportunity for infrastructure that could be something that I can use and incorporate with energy efficiency that might check the box of what my clients are looking for. And I also agree with what April and John said too. I'm not looking just for the restrictions on what we don't want in portfolios, but rather what companies are doing to make changes that are positive and good for the environment going forward, which also checks the box of what my clients are looking for. It's not a perfect solution, so I usually explain that to clients. I mean, you might have this company in the portfolio and you don't understand why you have it. But there might be another one that kind of checks the box over here. We have gender diversity over here. We have environmentally friendly over here. But all in, I'm trying to say, well, we had a goal to incorporate, a certain amount or percentage of your portfolio in this direction, and your return is this, and we've incorporated or integrated, 50% of your portfolio to align with these things. Sometimes my clients are like, well, I want 100% of that. And then I'll have a conversation about, performance based on what asset classes we might not have in the portfolio, or maybe it's more equity focused and not so much alternatives. And this is the reason why we might have underperformed this asset or this benchmark at this point of time. So I just try to keep it a very broad conversation because there are a lot of things that John and April are saying that I get it, but I couldn't talk about it or articulate it very well. And so I try to show not only what we're doing from a portfolio construction piece of it, but back it up with all the impact reporting that John's team and that April's doing that says, yeah, this is why this is aligned with some of the fossil fuel free type of investing. And this is what we are incorporating this into the portfolio, and here's the proof. So it's kind of my long answer to your question.
No, that's great. Just kind of a follow-up. I mean, do you find that clients are looking for this type of solution, or is it you presenting to them to let them know that this is an option?
I think both. I mean, when I at Morgan Stanley, I have a lot of resources and tools available. Prior to working at the firm, I was at another organization where clients were asking for it, and we just didn't have the tools and resources available. And then I was at had another opportunity where I was introducing the idea because it aligned on so many different things that the client was looking for. So I think definitely prospects, new business, referrals are coming to me because of the interest in the alignment to sustainable investment solutions. And then some existing clients that might not be there, they like the idea, but it might not be front and center in their mind. But I'd say new business is coming to me because of it.
Great. So I'm just going to go around here and anyone can jump in. It's been interesting to hear that all of you have been doing this for a long time. I mean, John, back to 2008 for ESG, I think is quite a track record. So this has been around for quite some time, but this is 2023. And we know in this era, everything is political, including ESG investing. Over the last 12 months, we've heard quite a bit of been in the news and gotten some backlash. And, I don't talk to clients on a frontline basis, but even, I've heard, from clients asking, about it in a political way, not necessarily, how an educated person would think. So, what are your thoughts on that? And what have your experiences been? I guess feel free to jump in, anyone. I won't go around.
Yeah, I'm happy to share MSCI's view. So I think, investors are looking for clarity, right? I think there's a lot of misinformation in the market and it's caused confusion. And our view is that ESG and climate are really not, political topics. the use of ESG and climate data provides another lens, or provides investors with another lens to understand their risk profile of their portfolios and effectively capture client preferences. If you were to ask an investor, do you want to increase transparency into your risk profile, and do you want your portfolio to capture your preferences? They would undoubtedly say yes. Now, if you use maybe the word ESG or climate, they may be, some may be hesitant, but effectively ESG and climate are just tools to provide an additional lens of transparency and preferences. So, similar to ESG more broadly, education is really very important and key for MSCI, as we do our work in this segment. Education is key for investors to understand, the actual objectives of integrating ESG and climate into their portfolios. And really, we view our role is to provide those tools and solutions for investors to do that. And again, that, this is just another way to look at the risk profile of a portfolio or to capture a client preference.
A couple of thoughts come to mind for me. One is, it's partly, obviously it's political, and I guess when it comes to politics, sometimes we can throw our thinking caps right out the window. But this partly is an education issue, where I think that the politicians want to make this a case of integrating ESG means sacrificing returns. And the data show that that's absolutely untrue. There's no single study that anybody should point to, but the metadata show that is an untrue assertion. We have done some research where we talk about reducing the selection universe, and that's the idea where people want to make the easy jump that, okay, if I'm choosing from a smaller pool, that's going to hurt my return. That's not necessarily the case. Remember what I said earlier about companies that score really well along ESG lines and comparing those to companies that score poorly. When we think of those that score poorly, they have much higher volatility and much higher tail risk. Something that's related to those things is that it's harder to predict returns for companies that score poorly along ESG lines. We can demonstrate mathematically that the fact is that even on a smaller selection universe, because it's easier to forecast returns on the remaining companies, you can actually maintain the same level of information ratio or risk-adjusted returns on that smaller selection universe once you integrate ESG. So, that's the type of education that we think is so important. In addition to that, I mentioned earlier using the implied temperature rise data set to build a strategy that allows us to invest in energy companies and utility companies, as long as these companies have commitments to align with net zero by 2050. That allows us to go in and talk to tradespeople, and it kind of is an interesting way to not really offset the politics of this, but maybe to have a deeper conversation around the politics, that, hey, this is actually good for your job, for your industry. And investing in alignment with that is actually supportive of your employment opportunities. So again, a little bit different way to think about it. You don't want to have a conversation with somebody that doesn't believe in climate change. You don't want to go in there and sell them net zero today, but you can engage them in other ways if you bring the data to bear to provide solutions.
Okay, thanks. Yeah, I listened to Chris Ellman speak yesterday, CIO of CalSTRS. Obviously, they incorporate ESG analysis, and his perspective is it's disclosure. Do you want more disclosure or less disclosure? But that kind of brings up a question John, you touched on it. If anyone else has thoughts as well, I mean, how have you seen disclosure progress over the last 15 years or so? See, now everyone's has some kind of report in a sustainability report. Obviously, that was not the case. I mean, how have you been able to get information? Have you seen it improvements over the last several years? Are you worried about, what they call greenwashing?
Yeah, I'm happy to comment. So I
Sure.
started my career many, many years ago as an intern at a company called Innovest, and I did ESG research. That company was acquired by Riskmetrics, which was acquired by MSCI. But having a corporate social responsibility report, even 15 years ago, was not by any means standard. There were obviously industry leaders who were disclosing on certain metrics, but I would say that both the number of companies that are now disclosing across the ESG pillars, as well as the level and granularity of data overall, has increased tremendously. We're also now seeing many corporate social responsibility reports being audited and so forth. So from a regulatory perspective, I think that's only led to the increase both in the level and number of metrics that are being reported, but also in the qualities. Clearly, we're seeing more regulations come out of EMEA, but we're also seeing some in Canada and then the US as well. So my expectation on the trajectory of the level of disclosure and also the quality is that it's only going to continue to increase and standardize in regards to the specific metrics that are being reported and how they're being reported.
Thanks. Go ahead, John.
I had some thoughts, but I didn't know if Kelsi wanted to.
No, that's okay. Go ahead.
Okay. Yeah, a couple of thoughts. One is we do see evidence of whether you want to call it greenwashing. I'm not sure if greenwashing is the appropriate term. It may or may not be. But what we do see for sure is there is a size bias associated with reporting. So, as you'd expect, bigger entities will report more on ESG data points. So that's true. And as a practitioner, one of the things we want to be mindful of are different ways that the data reflects that size bias. So for us, we make sure that we kind of take the ingredients from MSCI, but we're the baker. We want to extract the most information we can from the data that they provide. So something like adjusting the off-the-shelf ESG scores for country of origin for the companies is one example. Another would be even within a country. Let's take the US, for example, as the obvious example. You want to compare relatively like-sized companies. So you should compare S&P 500 companies to other S&P 500 companies, Russell 2000 companies to other small cap companies. You want to make sure that you're taking into account that size bias. Another thing that came to mind is with tightening regulation, and that's got multiple facets to it. One is it does encourage or enforce more reporting, and more information or more data is ultimately going to be better. And so we all as practitioners have to be on our game in terms of being able to examine and incorporate new data into our investment processes. So it's a really good thing. I think that, to me, I would say that MSCI has really kind of opened up the data fire hose, I'd say. They're pushing, making available a lot more data than they were a couple of years ago. Again, which is a great thing, but it takes a lot of work to kind of comb through that data and really be able to find out where the relevant information is so that we can create solutions for Kelsi and her clients that really mean something, that kind of cut to the chase, if you will. And last but not least, and this may not be the angle that we were going for, but in terms of disclosure, has been another burden on investment managers. And I'd even point to, let's say again, the PRI, the Net Zero Asset Manager Initiative. Some of these organizations, in my opinion, are really asking an awful lot of the asset managers, and kind of painting everybody with the same broad brushstrokes. And frankly, I think they were started for the right reasons, but it's becoming difficult to comply with some of what they want. We want to go in the same direction that they're intending to go into, but I think that they're kind of forcing us to do it in a way that we may not think is the best way.
So, this has come a long way since it kind of started as so more exclusionary investing versus the current framework of, ESG analysis. And we've had things like PRA come into play. So it seems to be an evolving landscape. And I'd love to hear from all your thoughts on, where this is going, where the trends are going, what the future looks like, and any kind of action items for advisors as we're into our kind of final minutes here.
Well, I'll just jump in. I'll say for me, I think I'm going to have more access to more investment options, and there's probably going to be, I'm going to find a solution for any asset class. I think that I don't know if this is right, but I can also see that at some point this won't even be, it'll just be part of what we're doing. It's a part of the due diligence process. It's part of every holding, but it won't be necessarily a new and exciting thing anymore. Everybody should be doing it. It's the way that the world is evolving, kind of. So I think it's just getting ahead of things a little bit to say that this is companies are needing to be disclosing more things. We're asking for better transparency on work environments and what's going on with the world. So for me, I think it's just, I'm going to have more solutions available, and I'm going to have hopefully more clients that are interested in this and want to keep talking about it.
Yeah, and to maybe go from there, MSCI is seeing that wealth clients are asking for solutions, and that they're now, aware of climate risk and want, ESG and climate integrated into their portfolios to manage that risk or to capture relevant opportunities. And so we really see, climate data and climate tools as a way to increase, investor engagement. And so to increase client retention, or even to attract new clients. Obviously, there's been a lot in the media written about the transfer of wealth, and we're seeing younger investors, very interested in the topics of ESG and climate, and looking for solutions that integrate both. So I think this is just the beginning, specifically for climate. And I think it's going to be on an upwards trajectory in regards to client demand and the types of solutions that are available, whether it's, product due diligence or portfolio construction or reporting and increased transparency. I think the use cases will only increase, and it's, exciting time to be an advisor or a wealth manager, because you can really, create bespoke and unique and innovative solutions for clients.
Yeah, I think just there's going to be more data available. More data means it's easier to customize for clients. We can see that the industry is really moving in that direction, right? More customization is better. So that really helps with respect to all the ESG data that's available. With climate in particular, we'd say that the climate science is really unequivocal. We know that our collective response to climate change is going to have a very large financial repercussions. We very much believe that having climate-related solutions as part of the portfolio and emphasizing those in the portfolio really puts the wind in our sails, and we think that it's going to be helpful to total returns over the next 30 years. The exact path of how we make this transition is unknowable, but that's what creates opportunity, right? That we don't know exactly what the path is going to be. But MSCI is really bringing to bear a great set of data to make sure that whatever pops up as increasingly important, we're going to have the ability to pivot into that for the clients, and really give them, again, something that we think is going to protect their very long-term investment horizon, and we believe will actually be incremental to returns.
We're the grocery store kitchen if you're the baker.
That's right.
Well, great. Well, thank you all. Thank you, Kelsi, John, April, for sharing your insights with us this afternoon. Thank you for all who participated. So we'll also be on our website shortly, so you can watch it again, tell a friend, and anyone that wasn't able to join us. But thank you, everyone, and have a great rest of your day.
Thank you so much.
Thank you.
Bye.
Bye-bye.
Thank you.